The rupee is at the bottom of the screen, and it's a very large move, 1.3, 1.35% on the currency, 80.71. And this compares to the close yesterday of 80.8 or so. So that's a strengthening that is welcome. Nilesh Shah of Envision Capital is with us. Nilesh, good morning. Good to have you with us here. It's a very large move overnight. How would you read it? And what does it do really for the market here? Because, we find ourselves at near highs, whereas the US market was completely bombed out. So how much of the rally we've seen overnight will we carry on here in India over the next few days and few weeks? Your sense?
Yeah, I think it's a great development, what we've seen, the rebound in the U.S. markets. India, of course, has been a stark outperformer and outlier in terms of what's happening globally. And in that context, what's happened in the U.S. just provides a massive tailwind for India to basically break out and try and make new highs. So I think that's great. It augurs well for Indian equity, and I see a strong a move ahead. And the outperformance that we've seen for pretty much the entire year, I expect that to continue in the next year as well.
Okay, like someone was saying earlier, right, Nilesh, achhe din aa gaye for the market. It's a new high you're looking at, and every worry that has been thrown at this market's face has been digested. And how, we were just talking about how the SIP flows are the highest ever that we've seen in the month of October. So what do you do now? If suppose there's a big up move coming, as an investor, which are the spaces to look at? Do you put your money all in, or do you think that perhaps you'll get better opportunities through the course of the next few months?
No, what it looks like, I think, is that the outperformance that we've seen is expected to continue. It looks like that the next few months are going to be pretty strong. As we step into early Jan, we're going to be having the fresh round of allocations for the new calendar year. Indian bonds are expected to be part of the global indices as well. And in the first quarter, the government itself is targeting for privatization of ITPI, or that's what the media reports suggest. So all in all, I think it seems to be a great time. I don't think timing the market can make sense in such an environment, especially when we've seen so much of our performance and corporate earnings have been strong enough. I think in that context, it makes sense to keep allocating as you have the liquidity. Going forward, I think even in India, inflation is expected to taper off. Rate hikes are going to be probably more modest. So I think on the whole, I think it's a great situation of liquidity, strong macros and strong micros as well.
Hi, Nilesh. Morning. It's going to be a great morning, actually, for the bulls going by the initial rates that we're having. But Nilesh, I wanted to ask you about the earnings season. We're halfway through this year. This was supposed to be a good follow-up year. Last year, earnings was on a low base. Do you see some bit of risk to the earnings estimates? And how have you broadly, read through this past earnings? Because there have been some big misses that have come in.
So yes, I agree. It's been a bit of a mixed bag. There are some sectors which have been outliers. So financials, especially banking names, they've reported strong numbers. But the manufacturing names, especially areas like pharmaceuticals, chemicals, and some of the other building material companies, they've had some margin pressure, and the volume of take has not been very great. But I sense all of this is likely to ease. We're beginning to see inflationary pressures start to abate. And I think as that happens, probably as we step into Q4, which is the March quarter, you'll probably see some amount of margin improvement. But I don't think that should be a source of worry, because investors are going to take now a look in terms of how FY24 is going to pan out. And I think FY24 should actually be better than what FY23 has been.
Okay, FY24 better than FY23. I just want to make a mention on a few stocks that are moving quite well. By the way, the pre-opening rates have settled now. So it's a 200-point rally that you're seeing on the Nifty, and plenty of stocks that are zooming around at the moment. From the headline index, it is the IT stocks that are coming back. Tech Mahindra, Infosys are all moving up. Apollo Hospitals, Dipan was also referring to that, doing pretty well. And in the broader markets, Fine Organics is one stock which has reported good set of numbers. Samvardhan Motherson Samil is up about 5%, post a good set of numbers. Ashok Leyland is up 3%, post a good set of numbers as well. So Nilesh, you want to leave us with some sectoral ideas? Autos has been a bit patchy. Some spaces have done really well, like commercial vehicles. Can't say the same with two-wheelers. But your thoughts here?
Clearly, auto components, I think, is going to probably outperform the broad auto pack, because in the auto pack, the OEM pack, you're going to see mixed kind of stuff, because some are going to lose market share, some are going to gain market share, and then there are different kind of products or segments which will work and some which may not work to that extent. But what it looks like relatively, auto components looks to be a much better space. We've not seen any major kind of pressures that they could be facing. Demand still continues to be good for them. They're reporting good revenue growth, especially some of the tier 2 auto component names look very good. Defense names are coming out with stellar earnings, and I think that's a great space to be in. Technology services companies surprisingly have kept up in terms of their growth. They've not yet faced any headwinds. Margins have kind of tapered off a bit, but they still continue to be very strong. So I think on the whole from here, I expect tech to kind of shed its underperformance and probably be a market performer for some time and then get back into outperformance mode sometime next year. So I think that's a great place. Valuations have come off out there, so I think it looks compelling. Second is, of course, defense, and third, of course, is auto components. So these three look to be extremely strong kind of pockets in the market.
Nilesh, I recall a couple of months back when you joined and you said it's a good time to start getting into IT, and I think that has played out pretty well. But you're saying that things are still looking good, and maybe the stock prices have factored in some bit of the bad news. But Nilesh, today tech is one of the big gainers, and you have the metal index as well that will do well because of the softening of the dollar index. Though there are plenty of headwinds out there, do you continue to remain negative on this? Would you use these kind of bounces to get out of some of these commodity-related stocks?
Yeah, absolutely. I mean, I clearly believe that that commodities, I think we've seen the peak for them. They have kind of, in a way, bounced back from the lows that we saw in the middle of the year, but I think these should be used as opportunities to exit. These are at best trading plays. These are clearly not investment candidates and therefore should not be part of a portfolio. And I clearly believe that we've seen the best in terms of metals going forward. Probably, yes, of course, there's some kind of softness in dollar index, which could trigger some bit of a rally there. But I think on the whole, I don't see a great environment for metals and for other commodities going forward.
All right, Nilesh, thanks a lot for joining in. By the way,